Okay, good morning, traders. This is Aaron from FP Markets with a brief week ahead preview. Now, before we crack on with the week ahead, I just want to touch on the prior week as we had a number of central bank rate decisions land, specifically the Fed. Now, as you can see here, the Fed maintained their target rate at between 4.25% and 4.5%. No surprises there, as you can see. We also had the usual rate statement, presser from Fed's Powell, and the updated economic projections, which are provided every quarter. Now, a couple of changes, as you can see here, this is the rate statement taken from the Fed's website. I've highlighted the changes in the additions in green and the sentence removals in red. Now, a couple of changes were made through their rate statement, notably that they added uncertainty around the economic outlook has increased, and they removed the economic outlook is uncertain. Actually, this was pretty much highlighted across all the central banks. We also saw the Fed noted a reduction in the pace of quantitative tightening, or QT, to $5 billion per month. Now, in his press conference, a couple of things I took away from Powell's commentary is that he emphasized that inflation remains somewhat elevated and acknowledged that it has been rising partly in response to tariffs. Now, he also stated that it is too early to notice any meaningful impact on economic data due to these tariffs, and remarked that upside risks to inflation have increased in the short term. But look, he did reiterate that the central bank's longer-term goal of reaching the 2% inflation target remains in place. Now, something else I also feel is worth highlighting from the summary of economic projections is that the federal funds rate, the Fed's target rate, is expected to remain at, let me just check my notes here, is expected to remain at 3.9%, 3.4%, and 3.1% for 2025, 2026, and 2027, respectively. Now, the longer run rate also remains projected at 3%. Therefore, as was widely expected, despite the uncertainty surrounding US President Donald Trump's policies, Fed members continue to predict 2 rate cuts this year, which closely aligns with the futures market, and that is currently pricing in around 66 basis points of easing. However, one hawkish, I believe was hawkish, observation from the dot plot is that compared to just one Fed member forecasting no rate cuts this year in the December projections, the March projections indicated that 4 members now anticipate no rate cuts this year. Now, going back to the calendar, we've this morning's already seen a bunch of PMIs out this morning. Let me just find the date there. Just bear with me here. So there we go. So we've had Germany, we've had France, Germany, and the Eurozone and the UK flash manufacturing and services PMIs out this morning. And to be quite frank, they particularly the French and German PMIs. These were difficult to trade, given the data was mixed. For me, this was a case of sit on your hands. We do have the US PMIs out later this afternoon at 1:45 p.m. GMT, and these will certainly be data points to keep an eye on closely. Now, ahead of this print, I do want to highlight that from the euro-dollar's technical point of view, in my opinion, it is echoing a relatively strong bearish scenario at the moment. Now, as you can see from the monthly time frame of the euro-dollar, we have, excuse me, we have seen price retest the underside of the 50-month simple moving average, and this is currently trading at 0.929, and we have modestly reacted from this area. Now, if you across the page on the daily time frame, we have what's known as a double top pattern. And this is formed at the underside of that 50-month SMA. Now, what's interesting here is that we have modestly clipped the lower side of the pattern's neckline. Now, from a technical analyst's point of view, given the close below that neckline, this allows technicians to project or estimate a profit objective based on the pattern's highest value to the neckline, and then we extend that from the breakout point, as I've done here. And this gives us around a pattern objective of around around 1.07 to target. So look, really, with the underside of the 50-month SMA in play and this double top pattern also in play now, I do expect that euro dollar bears will kick things lower to around the 107-ish level. In addition to this, for those who follow large spec commitment of traders data, the COT data, you will note that the euro is overstretched to the upside right now. And all I feel we need right now is some form of catalyst to see an unwind in these positions. In fact, out of the G10 currency space, the euro is essentially one of the most overstretched currencies to the upside right now, and the US dollar is one of the most stretched to the downside. So look, assuming positive data for the out of the PMIs today for the US, we could see some unwinding take place, which is consistent with the technicals being shown on this on the euro dollar charts right now. All right, so Wednesday, Wednesday, the 26th of March, will also be another interesting day to watch from a macro and fiscal perspective. We have Australian CPI data at 12:30 a.m. and we also have UK CPI inflation data at 7 a.m. This is shortly, I assume it will be shortly followed by UK Chancellor Rachel Reeves presenting her spring statement to Parliament, which I'm sure you can imagine will not be pleasant, especially if you're living in the UK. Now, in terms of the Aussie weighted CPI year over year print, we are expected to come in at 2.5% for February. Now, just note that we have been at 2.5% for back-to-back months from January 2024 and December 2024 to January this year. As I said, current estimates suggest another 2.5% print. Though we do have an estimate range between 2.6% and 2.3% according to Refinitiv data here. Now, in terms of where we are with the RBA, now the RBA for the first time since I think it was November 2020, if my memory serves me correctly, reduced the cash rate by 25 basis points to 4.1%. Now, you will note that the board echoed caution on the prospect of further policy easing, citing a couple of factors like upside inflation risks, resilient jobs market, and of course uncertainty regarding Trump's tariffs. This was also reiterated in the RBA's meeting minutes released earlier this month, which essentially aired that the previous rate cut was not a sign of things to come. If we look across to the the money market expectations, understandably, markets are now ruling out another rate cut next month, or are ruling out another rate cut this next month, around the 90% probability of a no change versus around a 10% probability of another 25 basis point cut. Though you will note that May and July are certainly on the table for potential rate cuts. Now, May is 18 around 17%, 17 basis points priced in for cuts, and around 28 basis points for the July meeting. So we are fully priced in for the July meet. Therefore, lower than expected data, lower than expected Aussie CPI data this week could have investors ramp up rate cut bets and consequently weigh on the Australian dollar. The guys, conversely, an upward surprise may also underpin the currency. This is certainly a data point to keep an eye on this week. Now, if we go back to the charts, the Aussie New Zealand dollar is one that I am watching very closely at the moment. Now, this may have played out by the time that the Aussie CPI numbers um, hit the wires, but nevertheless, this is certainly something I feel that's worthy of space in the weekend preview. Now, on the daily chart to the left here, we have what's known as an inverted Quasimodo resistance level at 0.981. As you can see, we are now testing the underside of this level. Now, the Aussie is up 0.4% against the New Zealand dollar right now, and that's in a one-sided move into this resistance here. But as you can see, we are modestly reacting from this area. Now, if we spin across to the H1 time frame, we also, in addition to this daily resistance, also have an H1 AB equals CD bearish correction, a bearish resistance area in play, and this is between the 1.272% Fibonacci projection ratio at 0.989 and the 100% projection ratio of 0.972. So this area is a resistance zone that I will be watching closely. Now you will find AB equals CD sellers will potentially position their stops just above this 1.272% projection Fibonacci projection ratio and target the 38.2% Fibonacci retracement ratio, followed by the 61.8% Fibonacci retracement ratio. Now, these levels are derived from the legs A and D. So as you can see, this is a potential D leg there, A leg. So I've essentially just, as you can see here, extended from legs A to D to give us the 38.2% and 61.8% Fibonacci retracement ratio as at 0.951 and 0.933 as potential targets. Assuming a downside move from here, traders often reduce risk to break even at the 38.2% ratio and can and often do reduce some of their risk at this point, take some off the table, and then finally take profit at the 61.8% Fibonacci retracement ratio. That's not to say some traders don't leave their some of their position in the market to run, especially if we're coming off a daily resistance as we are here. So back to the calendar. Bear with me, guys. Sorry about this. So back to the calendar, we have the UK data at 7 a.m. Now, CPI inflation, headline CPI year-over-year inflation data came in at 3% in January. This is the highest rate since early 2024. Now, February's reading is expected to slightly tick lower to 2.9% or ease lower to 2.9%, with the core year-over-year measure also expected to ease back to 3.6% from 3.7%. So look, last week, the BOE was another central bank on the docket that was widely watched, and it was for me, it was relatively uneventful. Now, the BOE maintained their bank rate at 4.5% with an 8-1 majority vote. And like the RBA cautioned that global trade uncertainty had intensified. Now, the BOE is in a tricky spot, in my opinion, amidst stagflationary risks, and this is essentially balancing upside inflation risks against downside growth risks. And couple this with add on to this, we also have fragile confidence in the UK. Now, although the BOE's vote split was modestly hawkish and the consensus was 7-2, a 7-2 vote, for me, it was a challenging event to trade out of. Looking ahead to this week's UK inflation numbers, like the Australian inflation report, look, if the UK inflation data comes in lower than expected, and the GBP could be sold off. Now, while any upward surprises, of course, might benefit the currency. Later on that day, of course, as I've said, timing is tentative. We do have the UK spring statement. Now, coupled with the ONS reporting a £100 million increase in public sector net borrowing in February, and this is compared to the February of last year. I think it's fair to say things are not heading in the right direction for the UK Chancellor. We have increasing austerity fears, and having staked her reputation on growing the UK economy, Reeves is not expected to make any tax changes today. However, she is anticipated to announce growth downgrades and is set to push through one of the largest spending squeezes seen in years to plug the black hole in the public finances that has emerged from, of course, slower growth and debt repayments. Now, I will look at the pound. I do really want to highlight the pound chart. It's nothing out of this world, of course. We are now testing the 1.3 handle, 1.130 handle. Excuse me. And we are now above this support at 27.15. This is the monthly time frame, guys. So it's quite a longer term chart. But we are fast approaching this resistance at 31.11. Now, this resistance is key, in my opinion. And certainly something to be watchful of this week, given that we have the UK CPI data and, of course, that spring statement in place. So 131-ish will be on the radar, especially for us and the team here. Finally, on Friday, the 28th of March, we have the US PCE data out. And this is undoubtedly one to watch this week. Although the headline data for CPI and PPI numbers eased in January, these were released earlier this month. We have seen beneath the surface the components contributing to the PCE. Sorry, guys, that headline CPI and PPI data eased in February, not January. And look, if we look beneath the surface, some of the components contributing to the PCE data were stronger. This is the main point I really wanted to get across. And this indicates the possibility of higher or more persistent PCE numbers this week. Now, expectations, as you can see from the calendar here, for the year-over-year and month-over-month headline PCE price index measure, we are expected to remain unchanged at 2.5% and 0.3% respectively. Now, on the core front, again, month over month, we are expected to remain unchanged at 0.3%, but on the core year-over-year measure, we are expected to rise slightly, see a rise by 2.7% from 2.6%. Now, should PCE data exceed the median estimates here, expect to bid across the US dollar and of course US Treasury yields, as investors will likely pare back those rate cut bets with follow through selling possibly across the equity space. All right, guys, so that's about it from me and the research team today. I do hope you took something away from this video. Please like and subscribe to the channel for more videos like these. Thank you very much for listening and have a great week ahead.